I think gold and silver have begun to emerge from the recent pullback. Now, silver got whacked today, but silver, we call silver the little dog on a leash. And the mama, the holding the leash, is gold. So anytime you think you see silver jumping off a cliff, it's got a leash attached to it. And if gold isn't jumping off a cliff, then silver's not, okay? Keep that in mind. And next thing you know, silver turns around, it's $1 off the low, that kind of thing. I think we're turning back up after the congestion. Gold got within, a couple days ago, within $1.50 of its all-time high. And somebody said, I think I'll sell it and risk a nickel to make a dime. Okay, they did. Okay, great. But I think the major trend there remains positive. It remains no longer congestive like it was all during mid-2020 through early 2024, where gold was in this up-down range. In March of last year, we declared that process of corrective process in silver in the miners and sideways process in gold was over. We're going up. Okay. At that point, gold was just above 2,000. At a place it had been 3 or 4 times before in the prior couple of years, so no big deal, but it was to us. And sure enough, you've reached 2,800 recently. Silver at that point was $25, headed toward 26. Didn't mean much on a price chart, but within 9 months it reached 35. Right now we're either side of 31 for the last couple of weeks. I think they're continuing up. I think the main thing to propel them at this point is fracturing of the stock market. When the money flows out of that beast, as it will, it always goes somewhere else, and that place has almost always been gold if you go back through history. And I think that's likely to happen this time. So when you see the downticks in the stock market, take that as a positive background feature for gold. Now, we've been viewing the action in the stock market as topping action for the last couple quarters, actually. And if you look at the S&P, just for example, right now you're trading probably about where you were in the peak in mid-July. Okay? So you've gone nowhere. Okay, yeah, you've been up, you've been down, but it's really not the dynamics. If you even just stand back and look at price since the 2009 low in the pullback into 2022, and then since 2022, it's really getting sluggish up here. And the S&P made a new high in order to get those headlines. They love it. All-time new high, Trump's elected, all this stuff. NASDAQ 100 did not. It missed it by a little bit, no big deal. But the spread relationship, which a technical feature we measure, between the S&P and the NASDAQ 100, NASDAQ 100 being the leader index. Leader meaning it was the most percent gainer from 2009 to the present, and it will be the most percent loser once you go into a bear trend. This was the case back at .com, for example. Internet was going to take us off the planet. It changed the world. And in fact, it did. But the NASDAQ 100 dropped 82% between 2000 and 2002. It was the leader then. It's the leader now. The technicals we see on NASDAQ are such that the recent price lows we've seen a couple weeks back, which were just below 21,000 in the 20,700, 20,800 zone. I'm talking NASDAQ 100 now. You don't want to go back there again and close a week there. Not because of price, but because we run quarterly momentum of the NASDAQ 100 and the S&P. S&P's already fractured itself prior to the recent rally. But the NASDAQ has yet to break our key structure. And when it does, we think there will in fact be a sharp layered decline. It doesn't have to be a crash. Could be, but doesn't have to be. Instead, I think you probably should expect something more like the bear market. I think that's what it will begin. Will commence in double-digit percent slabs of decline. It's been our pivotal point in our reports because we look at all 4 major asset categories. We don't just look at gold and silver. You can't do that. They're impacted by other markets that impact central banks, that impact the growth in money, et cetera, et cetera. So they're all tied together. And when you break the stock market, I think that's when you will start to see the verticality, which we've already seen some pretty good stuff. If you stand back and look at it, ignore the zigzags that always occur. Gold, for example, last year closed at 24, close of 23 to close of 24 was up more than the S&P. Silver matched basically the S&P. Nobody cheered that. It wasn't on the major financial channels. It was all stock market. So they've ignored that reality. And I think you'll start to see a further separation where gold continues up and its related markets. And the other paper assets start to bleed. And when they bleed, that money goes somewhere. Now, as far as silver versus gold, it's dirt cheap off the page. We know that, historically speaking. Now, it's either fundamentally lost any rationale for being, okay, which we know isn't true, or it's an error. Silver's just priced too low. These things happen in markets. Markets get priced too high and they pay the dues. Markets get priced too low for so long and they go up and you hardly need an excuse. It's just that they were underpriced for too long. And I think silver's in that category. Technically, we can measure the spread relation between silver and gold. And I've got some numbers that we're monitoring that wouldn't take much on the upside over the next few weeks even, where silver gains a bit to gold, and it will break out on these technical metrics of the measuring the relationship between the two. And I would bet that would probably coincide with gold one being back to and through its highs, 2,800, but silver also back up to its highs, 35. At that point in time, silver's still cheap to gold. I mean, like you said, gold's way over its 2011 high and so forth. Silver's not above its dual highs at 50. I think it's the next move that's likely to blow that stuff out. And I don't think 50 is a target, by the way. If we get going in this next leg, and I think we will, stock market being a key factor, that $50 is just it's a paper target. Everybody's looking at it, but you'll blow it out. You'll go well up in between there and 100 or something. I've got some reasons to think the mid-60s before you even stop for a pause. But the key right now is that what happens in this current situation, break that stock market, break the Sensex, break the Nikkei, and you'll have central banks go berserk, and we know what wins when they go berserk. I'm personally bought 4 major silver miners recently, and it is disclosed in all of our reports in the back. I own this and that, I'm emphasizing right now not gold and silver, but silver over gold, but also the miners. The miners are dirt cheap compared to gold. Historically speaking, go back 20, 30 years, you can look at the relationship between them. And also the gold miners as a subsector of the stock market are off the page cheap compared to the S&P. But that sort of hides the truth. The top chart shows the XAU index, which is the Philadelphia Gold and Silver Miners Index. It's been around a long time, since the 1980s, so this is why we use it. It's got a lot of history. And when you look at that spread chart versus gold, you'll see that the spread relationship between XAU and gold, and what we do to measure that is we measure the price of XAU divided into gold, expressed as a percent. And so back in the 1980s through 2008 or so, XAU index was trading at 25, 30%, even got up to 38% of the price of gold. XAU versus 1 ounce of gold. And the lows were around 17, 18%. Meaning whenever you get a dip and the price of XAU dropped to about 18%, it would find support. And so in that top chart, you'll see there was this range at a high level. But in 2008-9, just prior to the onset of the gold bear market, the spread broke, where the miners started to break in relation to gold, and their performance collapsed down to when? To the December 2015 low. So the spread, in other words, the lessening performance of the miners versus gold, dropped until gold and silver and miners actually made their price low, which was December 2015. But if you look at that spread chart, you'll see that over the last 9 years, since late 2015, the spread has gone sideways. Yes, at a very depressed level, but it hasn't gone down anymore. Now, you say, well, that's a dog. Well, actually not. Right now, the spread is a little bit higher than it was at the close of December 2015. Now, what does that say? It says that miners have been a par performer, sideways performer to gold, meaning they've gone up just as much as gold has during the last 9 years. You tell the average investor that and he'd chuckle, but it's a fact, measurable fact. The miners have matched the gains in gold. The question is now, when do they break out? And you can see I've plotted a 3-point downtrend line on that spread. But there's also this basing range of 9 years. I think we're going to break out of this range. And we measure various things to determine when that's occurring, not just this spread chart. But when you break out, look at that line overhead on the spread. The old lows at about 18% over. That's resistance level now. It was support for years and years. If you break out now from where we are, you're likely to find resistance up there. But let me tell you, we're trading just above 5% now. That's a triple and more in the spread relationship. What that says is if that spread breaks out and you even just go to the bottom end of the prior multi-decade range, that means gold miners will have tripled the performance of gold in getting there. Okay? So at that point in time, if we see that kind of breakout, I'm of the view that in this phase of the gold bull market, the miners will wake up and no longer just par perform to gold, but vastly outperform it. And just go back to an old low. It's hardly asking for a home run even. Anyway, there's another relationship to this, a chart below it, which shows similar type behavior of the XAU index, the gold silver miners, versus the S&P 500. And as you can see on that chart, if you go back into the mid-1980s, you'll see it was up at 50%. I mean, the XAU was trading half the price of the S&P at that time. Wow, okay.